So when we think of adjusting journal entries, there's really a couple types. So one is we've got prepayment related adjusting journal entries, and then we also have accrual related adjusting journal entries. In this video, we're going to talk about those of the prepayment variety. So what are we talking about when we look at prepayment adjusting journal entry? We've really got a couple types. So now we've got some subcategories here. We've got prepaid expenses, right? Something like insurance. You pay in advance for your insurance and you use it up as time passes. And then we've got things like unearned revenue, where there's prepayment going on, but it's actually a prepayment on the part of your customer and you haven't earned the revenue yet. And so let's just talk a little bit about what is going on here. So when we think of these, why an adjusting journal entry would need to be made with these prepayment type entries, what we've got is that the account in question is basically expiring over time, just slowly over time, and it's not something that you would record on a daily basis, or it's just something that's kind of like expiring as it's used up. Expire as used up, like supplies or something like that. And again, you're not going to go every single second and make some kind of entry. You just look at the end of the period and see what's been used up. So let's go ahead and take a look here and see an example. And we're going to start with a prepaid expense. Okay, that type of prepayment. We're going to take a look at one of those and just see how it would play out in actual practice. So let's take for our example that you purchase a 12-month insurance policy, 12-month policy for $12,000. Okay, and let's just assume you pay cash, you pay $12,000 for some insurance policy for your business. So what's our initial entry going to look like? Well, let's say that you do this on January 1st, 2015. So what's going to happen? Well, you're getting an asset, right? So you're getting prepaid insurance. You're going to debit that. That's an asset account. You're going to debit that for $12,000, right? Now we're assuming here that you pay cash, so you're going to credit cash for $12,000. But then your boss says, let's say it's the end of the month. It's January 31st, 2015, and your boss says, look, I want you to go ahead and I want you to make some adjusting journal entries. We're going to put together an adjusted trial balance, and we need to make some changes. So now you have to say, okay, look, we bought a 12-month policy, right? Now we see that 1 month has gone by. So, well, what's one way of thinking about that? Well, one way of thinking about it is we've used up 1/12 of our asset, right? This $12,000 asset is not really a $12,000 asset anymore. Now we should multiply it by this 1/12, all right, and say, okay, how much of this asset have we used up, right? So ultimately we're going to say, okay, well, we've got this 12,000 divided by the 12 months, right? So $12,000. So that tells you this is $1,000 a month is the rate at which we use up this asset. Now, what happens when you use up an asset? Well, you say you have an expense, right? And in this case, we're going to call it insurance expense, right? Because we've used up this insurance asset, and insurance expense is going to be $1,000, right? Just that $1,000 a month. It's been 1 month, so that's pretty simple. Now, what do we credit, right? Because we need to make this balance. Well, we're going to credit prepaid insurance, right? Because we can't keep that asset on the books at $12,000 anymore because we know it's not worth $12,000. Now it's worth $11,000. So what do we have to do? We have to deduct $1,000 from it. We have to credit this asset, and crediting an asset reduces the asset. So we credited it for $1,000. So now we've made an adjusting journal entry to reflect the fact that we've used up some of our policy, some of our 12-month policy. We've used up 1 month, and now we've adjusted for that fact at the end of the month. Okay, so that's a type of, when we're talking about a prepayment, we're looking at a prepaid expense, right? But also, you can have kind of this prepayment issue with unearned revenue. Now, if you're not quite sure what unearned revenue is, I'll just briefly explain here. You're going to, I meant to have example, not EXP. So for this example, we're going to do unearned revenue. And unearned revenue is basically the customer has sent you some money, but you haven't actually done the act in question that would entitle you to recognize this as revenue. We have another video on revenue recognition, so you can watch that if you're not quite sure what I mean. But let me give you an example that'll make it a little bit easier to understand. So this unearned revenue, let's say that you sell a 2-year magazine subscription to one of your customers. 2-year magazine subscription. Now, what happens when you have a magazine subscription? Well, the customer typically sends you the money up front. So let's say that in this case it's $240, right? So the customer sends the money up front, and now what you have is you have this money, this $240, but you haven't delivered the magazines yet. So it's not revenue yet, but you got the cash. So now we need to make an entry to reflect this, and then I'll show you what the adjusting entry would be as time goes on. So let's say that this is January 1st, 2016 is when you sell this policy. Okay, so what is going to happen is you're getting cash of $240, right? That's pretty simple to figure out. And then we're going to match that with this unearned revenue. That's going to make this balance, this unearned revenue, $240. It's not earned yet because you haven't delivered the magazines yet, right? So now it's, let's say, the end of the quarter. Right, so it's March 31st, 2016, and your boss says, look, it's the end of the quarter, and now we have to go ahead and we have to make some kind of entry to reflect the fact that now 3 months have gone by, and and this was a 2-year subscription, so that's 24 months. So 3 of those 24 months have gone by. So now we have delivered 3 months of magazines, and now we can go ahead and start recognizing that some of this unearned revenue has become earned, and now we're coming out with our quarterly report, and we want to go ahead and we want to make an adjusted journal entry to reflect this 3 months that's happened here. Okay? So what we're going to do is we're going to say, okay, look, there's 24 months, right? 2 years times 12 months in a year. So we're looking at 24 months. And ultimately, this is a $240 subscription. So we can just say, okay, well, what if 240 divided by 24 months, right? So that's going to be $10 a month. That's ultimately what we recognize every month. But what's happened here? We've got 3 months that have gone by. This isn't just 1 month. So we're recognizing this at a rate of $10 a month, but we haven't recognized it yet, and it's been 3 months. So we multiply the 10 a month, right, times 3, and that gives us that we need to make an adjustment for $30, right? So how do we do that? Well, we need to say, okay, look, $30 of this unearned revenue has now been earned. So we're going to say, well, we need to reduce unearned revenue. We need to make an adjusting journal entry. This is an adjusting journal entry here. We're reducing unearned revenue by 30, right? Now we credit revenue, because we've earned this, of $30. So what we're basically doing is saying, okay, look, so let's assume that we had, just say we had a T account for unearned revenue. All right, so we have this T account. It's a liability, so it has a credit balance. So the beginning balance, before we made the adjusting journal entry here, before we did that, the unearned revenue would have had a balance of $240, right? But we made this adjusting journal entry here to reflect the fact that time has gone by, right? Time is passing by, and now we've actually can record 30 of this as revenue because we've delivered three months worth of magazines. So now we go and we say, okay, well, now we're going to adjust this unearned revenue account, right? We're going to have a debit to it of 30, and then now it's going to be, if we had our adjusted trial balance, right? So you start with a trial balance, that would have the 240, would be on the trial balance, but now we make the adjusting journal entry over here, and then we've got the adjusted trial balance would show 210 in unearned revenue.